So what JJ's having you guys do, kind of forcing you to market yourselves, this is ridiculously important. It's not necessarily going to get you a deal tomorrow, but you fast forward 5, 10 years, the most important act or the most important role I have in my business is getting in front of as many people as possible. We essentially network and build lists. It's what we do. So building the habits of doing that now is going to be extremely valuable to you moving forward. We need a population that rents. This is straight up census data. You can look up the census data from 2016 for any place. And then we'll get the 2021 probably by next year, I would think. And that'll have what percentage of your population are homeowners versus what percentage rents. We like that somewhere in the 30 to 60% range, somewhere in there. Gives you a nice batch of people that can be your tenants. We want a flat-ish market, and I'll talk about that more in a minute here, but I don't want it going crazy high in the good times, and I don't want it going crazy low in the low times. I want boring. We're looking to be here for 20, 30 years. I don't like surprises. We need that market rent versus the purchase price, the cash flow. That's that 1% rule we just talked about. The market itself, you have to be able to buy rental property that works. Some places we can, some places we cannot. And then my new metric here is actually population density per square mile. This one's kind of interesting because we're looking at it long term. COVID has given us some really cool insights into the way local, state, and federal governments will behave under stress. And one of the things that we were looking at is how did they interfere with our rental businesses. So we noticed that in places with much higher rental population density, the local governments passed laws stopping eviction, adding protections, and preventing the need for the tenant to pay us very quickly. Where the lower population density, they didn't do that. It didn't happen at all. And even with the CDC's federal stuff, they're still somewhat business friendly. We can still run our business. So what we were looking at for population density, I don't have these as hard numbers. I'll give you guys kind of a range. What I'm seeing is between 800 and to just about 2,000 people per square mile seems to be the magical sweet spot. Once we start getting over 2,000 a square mile, we started seeing the local governments really interfering. I'm working on putting together better data on that over time, but it gives you guys an idea. And then extremely high population density is actually causing a bit of an exodus in the rental world. So I'll use Manhattan as an example. Their density is 24,000 and some odd people per square mile. And there are, as of last week, just about 15,000 actively vacant rental units. And they landlords are offering 2 months of rent to sign a lease with them right now. So that is not a place we want to be. That's too high. So when I'm looking at population density, I want something in that 800 to 2,000 range. And remember that populations grow year over year. So over the next 15, 20 years, I don't want it to cross that threshold. So if I'm already at like 1,900, I might only have a few years before that population density changes and the behavior of that local government might come to reflect what we're seeing now. So just something for you guys to keep in mind. It's not a crazy important thing, more something we're looking at big picture. You guys don't need to be sold on real estate, but you might have to sell others on real estate, especially if you're going to try to convince them to lend you money. So this is the S&P 500 over the last 20 years versus the home price, the median home price in Allegheny County, Pittsburgh, Pennsylvania, for the exact same time frame. Now, you can see the volatility in the stock market versus real estate as a vehicle. Every year, that real estate's going to be heading up almost every time. Those gray lines there, those little darker zones, these are recessions, right? So everybody loves to talk about the real estate bubble pop in like 2008. Here it is. If I was in the S&P 500, my valuation is dropping by a lot. You know, we're seeing like a 70, 80% drop there, right? Extreme loss of net valuation. But what's going on in Pittsburgh? Nothing. It was boring. It was flat. This is what I mean by a flat market. If I brought up the housing prices for different areas, you would actually see some spikes here. That's the infamous housing bubble pop. You tend to see it in higher value areas. So when we're looking for rental markets, we actually want this to be nice and boring. If this line is going up too high, if appreciation is too high, that tends to outpace the economy and it tends to outpace rent, which makes it more difficult for us to get the ROI we need long term. So it's a little bit of a different game than we would have if we have an extremely appreciating market. We have those values going up very, very quickly. That's going to be the kind of market we want to flip it. When it's kind of going up nice and gradual like this, sort of boring, that's a good market to be renting in. So something for you guys to keep in mind. All right. Rental real estate pays us 5 different ways. And it's important to understand them all, especially if you're going to be buying property off of somebody. The way they're presented to you can take these into account in different ways. So the first and most obvious one is the cash flow. After we pay, they're going to be paying our rent. We're going to have a bunch of expenses. Once we pay all those, there's going to be money left over. That is our cash flow. Each and every month, that better be in the positive, right? So that's way one, we get paid. Way two is we get a debt pay down. I've done entire calls on this, so I'm not going to spend a lot of time on it right now, but we don't tend to buy rental property in cash. It's not a great idea. Our preference is to leverage it as much as possible. I want somebody else fronting that bill, other people's money all the time. So every month I'm going to have a mortgage payment on that property, but I'm not paying that mortgage. The tenant is. So I get that debt pay down and I'm gaining the principal on that. Depreciation. That is the money that the IRS lets us write off of our property every year and makes us pay less in taxes. It's good stuff. You can translate it to an exact dollar amount based on your personal tax bracket. It's an inflation hedge. This one's a bit tougher to understand. Rents usually don't go down. They go up, and they tend to go up at least by inflation. So if I buy a property today that's renting for $1,000, 10 years from now, if that property went up only by inflation, I'm probably at around $1,300, maybe $1,350 or so. But the buying power of that $1,350 will be approximately equal to the $1,000 I'm getting today. So it's inflation adjusted. Another really fun one, Mark, Cheryl, don't listen to this. This is not for lenders. Your ears are too sensitive. Inflation usually works against us. It's like, think of it like financial friction. It's just always going to be against us. But there is a time when it works for us, and that's when we borrow people's money. The dollars that we pay somebody back with on a 25, 30-year mortgage are actually worth less than the dollars they lent us. That's an effective buying power. So it's something you can actually adjust by. You can take your annual inflation rate and subtract it off of your interest rate and find out what your effective payback is. So it works in our favor. All right, really fun thing. You're not going to see that in a lot of other investment vehicles. All right, and then the last one here is appreciation. That is the idea that the value of houses goes up, right? So that's this right here. If I bought a property in 2000 for 120 grand, that's the idea that if I went to sell that bad boy today, I'm going to get over 200,000 for it, right? That $80,000, that's appreciation. And that's good stuff. But here's the thing. You've crossed a line with that one. All of these other pay downs, or all these other pay types, these are all very predictable. These will happen. This one, appreciation, is speculation. You are no longer investing when we talk about appreciation. It's a guess. It's an educated guess. But any of you guys who've ever done stocks before, prior performance is not indicative of future performance, right? That's That's a bit of a logical fallacy for us. We think that because the prices have been going up for the last 20 years, they're going to go up for the next 20 years. That is not inherently true. And if anything, I hope everybody has taken away from 2020 is that years are not equal. Some of them throw us a real curveball. So buying a property and counting on appreciation is a gamble. That can be a bit risky for you. So as an investor, I don't recommend that. In our turnkey business, we leave appreciation out of every single evaluation. It's not there. It's by default, it's zero. We assume it's not there. If you want to add it in, we consider it the bonus plan. Most of our competitors, as far as I'm aware, do the same thing. But I would consider it a bit of a red flag. Anybody who's trying to sell you on high appreciation. Basically, guys, ignore it if you want to be safe. Okay. All right. Risk and reward is a law of nature. It happens to apply very, very well to our business. So for those of you who have not heard this kind of thing before, when we talk about different classes of neighborhoods, upper class, middle class, lower class, that can be a bit of a political hot button. It's a bit touchy to refer to it that way. So in commercial real estate, we sterilize the terminology. We talk about markets as A market, B market, C market, D market. And that A market would be your upper class, high income. B market's upper middle class. C is middle class. D would be your lower middle class. And then E exists. It's your blasted out war zone that nobody lives in. So we're not going to invest in any of those. Those letters, that designation is an opinion. I can't stress that enough. That is definitely an opinion. It may be an opinion based on some data, but you ask any two investors their opinion on where shouldn't you, or what's a good market, what's a good area, what's a bad area in even where you guys are investing, you're going to get very different answers. So when I discuss classes of property, I always combine them. So instead of talking about an A market or a B market, I'll say it's an AB market. So depending on your opinion, it could be the really high one, it could be the next one down. Same thing for middle class, I always say those are BC. And for our lower income properties, I just combine it to CD. So that's something, I don't know that a lot of people do that. That's how I do it. I'm not going to argue the opinion. We're going to give you a general idea of where they fall in the world. The higher class, the location of the property, the lower the cash flow. And that I mean, when you think about it, it makes a lot of sense, right? If I'm going to buy in the best zip code in the city, I'm going to pay more for that property. I'm going to pay more dollars per square foot to acquire that asset than if I bought it in a crappy area. The rent doesn't scale linear like this. It doesn't go that way. So we're going to get more rent, but not necessarily enough to cover that difference. So AB class, we usually factor, generally I will call those capital retention. So we're not buying AB really high-end property to get a great return. Most of the time you can't. We have to pay too much for it. Sometimes we get lucky and we'll find a sweet little deal in there, but most of the time they're not going to cash flow super great. Instead, we're going to take advantage of those other pay types. I'm going to be looking more at the debt pay down, the depreciation I get, and I'm going to really care about that inflation hedge. And appreciation tends to be more predictable in those higher end areas. Most of you, when we're looking for financial freedom, are not going to be buying AB class property. We don't buy any of it. I only owe a few, and it's because they were packaged with other stuff. We don't seek it out. By default, we're going to go for the balanced kind, the middle class, the BC level. That's where our rents versus the amount we're paying for the property are going to be, and the quality of the property we're going to get are most balanced out. So if you're talking to us, if you're talking to Passive Income Club, this is pretty much where we're going to assume you want to be. Unless you explicitly tell us otherwise, that's your default happy place, right? It's the middle class, working class properties. And then we have CD properties. These are going to be your lower income. These are going to be Section 8 or just in the cheaper areas. Rents here tend to be very high compared to the purchase prices, right? So when we're looking at what class of property we want to be in, it's straight up risk reward. When we go to those lower end areas, we may be dealing with more management type issues, tenants who are less financially stable. Sometimes we say they need more repairs. That has not been my experience, but it's a fair assessment up front, I think. The other thing, though, that is turned this on its head a little bit, again, COVID is screwing with our world really bad. We're seeing situation now nationwide where the public is being told they don't need to pay their rent. It's definitely a perception problem. And we're now forced to educate our tenants on, no, you still owe it. I might not be able to evict you just now, but you definitely owe me your rent. So that has actually made Section 8 a lot more attractive. The government hasn't missed a payment yet, at least in my world. Maybe there's some other housing authorities that are a bit more screwed up. But in Pittsburgh, we've been getting paid like clockwork every single month, no payments missed, and everybody's happy. So the risk in those CD Section 8 type neighborhoods has actually plummeted in the last couple of months compared to everything else. It's kind of interesting. And on top of that, they get the best cash flow because we're buying these properties cheaper. So just something to keep in mind. All right. In a beautiful, perfect world that I would love to live in, we buy a house for whatever, and they're going to pay us the rent. And whatever that rent check is, we get to take 100% of that rent check, and we get to put that bad boy in our pocket, and that is our cash flow. So if I need $10,000 a month for my financial freedom, all I need is 10 properties to pay me $1,000 a month, and I'm good. That would be awesome. Unfortunately, that's not happening. We have costs, we have expenses on these properties. So these are the ones that we have to make sure we're covered on. First one is our pity party. That is principal, interest, taxes, and insurance. Basically, guys, this is your mortgage payment. We don't buy these things in cash. If you do buy them in cash, you still have taxes and insurance. Okay, so we have to make that payment every month. That's coming off the top. Management. You're all using management. If you're thinking about not using management, just right behind your eyelids that you're using management and sleep on it for a while. Management charges a percentage of rent. There's a couple other fees associated with it depending on the individual company. But the easiest way for us to talk about it is they take a percentage of rent. Industry standard nationwide is 10%. You may find it cheaper, you may find it more expensive, but 10%. Vacancy. Again, in a perfect world, every single month somebody is living in my property, and every single month they are paying rent. That is not a thing. People will not pay us sometimes, and we will also have times where people move out and we have to find new people to put them in. We account for that by holding back a percentage of rent every single month as well. We treat repairs the exact same way. Stuff's going to break. Entropy is guaranteed. We're going to hold back a percentage of rent every single month, so when we have to send our repair crew out there, the money is there to handle that and keep that in the asset column and out of the liability column. And then at least with single family property, the default is we don't pay any utilities. The tenant pays everything. But you might have a situation, especially in multifamily property, where we are paying or including certain utilities. So those costs have to be accounted for as well. Right, so just something to keep in mind. These costs come out before we get to take our cut. We get the cash flow that is left over when that is done. All right, so let me talk about these percentage ones. The vacancy and repairs are the two big ones. And I've done entire calls on this where we went into the math behind it and everything. The way that most landlords handle it is with a percentage. So you can figure out, usually your management company can give you information on what this should be. what you should hold back every month to cover vacancy. Again, that's a combination of people, that's physical vacancy, nobody's living in the property, and that's also economic vacancy. They're living in our property but not paying us rent. So how much do we need to hold back so that we still have our cash every month to pay those other bills? And then we have repairs, same thing, it's a percentage. We use those based on the location and class of property. I use a lower repair reserve percentage in middle class property than I do with our Section 8 property. I use a slightly higher one. Okay. Now, percentages only work if you have enough property to let them work. Otherwise, we can have a bad week and get slammed really hard. So, for example, let's say we got a property that I'll just stick with this hypothetical property that rents for $1,000 a month. If I set aside 10% for repairs, I'm setting aside $1,200 a year. All right, that's a pretty healthy repair budget by most standards. That could cover one hot water tank and maybe 2 plumber calls. That's it, it's blown. Doesn't take much. Little bit of bad luck, and that is gone, right? Same thing, if I set aside that same amount for vacancy, $1,200 a month, or $1,200 a year, that means that it takes me 11 months to afford 1 month of non-payment. Maybe that works, maybe that doesn't work, right? But here's the thing. If I own only one property and that property goes vacant, I now have a 100% vacancy. I still owe my pity payment. I may have a repair bill, and I have 0 income. So the fewer properties I have, the higher that reserve has to be. Not every property is going to have problems every year, but some properties are going to have problems in a year. If you only own one and it happens to have its year of problems, that can actually cause you to have what we call an owner distribution, where we're going to have to reach into our pocket and spend more money in order to make it a cash flowing property again. We don't like that. I'm downright allergic to that concept. Instead, the more properties I own, if I'm holding back, let's say it's a lot less money. Let's say I'm only holding back $30 a month for my repairs, but I own 100 properties. $3,000 a month is enough to handle that catastrophic problem every single month, maybe even a couple of them. And the stats, that percentage starts really working in my favor. Same thing, vacancy percentage, more than enough to cover a unit or two being vacant. And even if it's not, the cash flow from the other properties can probably come in and still make those mortgage payments, even if we're trying to turn over a few units. The more units you have, the less risk you are at. So we have to have a lot of properties, one, to make our financial goals. That's the whole reason I'm assuming most of you are doing this, right? Financial freedom, getting high enough returns to be free. And 2, the more you have, the better it works. It puts us at less risk and makes it easier for us to get those returns. Okay? So just like puppies, more is definitely better. So a very incomplete list of funding sources for you guys. So how do we pay for these properties? We're going to use lenders to pay first, to get first position. All right. So that in the kind of lending we get, you're going to get somewhere between 60 and 80% of the purchase price on any given portfolio of properties. Most of the lending we're dealing with right now is at about 75%. That difference, that 25%, we're going to have to come up with, right? We need that capital. So where do we get it? So a incomplete list of places we can find this cash. Easy one's your bank account. If you can write a check for it, then this is real simple, isn't it? A home equity line of credit can be a good choice. When you're using HELOCs to buy rental property, read the small print. Okay, we're going to be paying for that out of cash flow, and if you have to pay those back in a really short time frame, like 5 years, 10 years, your monthly payment may actually be too high for it to make sense. So you've got to make sure that the HELOC you're dealing with can work for that. I have seen some HELOCs that are absolutely incredible for buy and holds. One of our buyers had one that I have no idea where they got it. I need to ask them. They have a HELOC that is interest-only payments for 10 years. And then I'm like, this is perfect. Buy a bunch of properties and refi later. They're going to be fine. So you can get some really good ones, but just because you have a HELOC, I know a lot of you have looked at, or through Fortune Builders, we learned to use HELOCs. That's generally on the idea of we're going to use them short term for like a fix and flip, not so much that we're going to be holding these properties for 5, 10, 15 years. So make sure you read your small print and see if it's acceptable to use a HELOC. You can liquidate existing investments, stocks, mutual funds, all that other fun stuff, right? Stock market may or may not be a great life choice for people right now, but if you're allergic to volatility, it's really good choice to maybe move that into a more stable vehicle. Self-directed retirement accounts. These are their own animal. Definitely talk to people who understand this very well. You're going to need to talk to your self-directed custodian. There's a bunch of rules around it. There's upsides and downsides. There's rules we have to follow with the financing, all to keep your IRA safe. The other thing that works super, super well is you can lend on passive income properties. It is so much easier and safer than lending on a rehab, because we don't have a construction job and maybe it sells to deal with. So cash flow is a real easy lend. And then somebody else. If you don't have the cash, maybe you take on a money partner who does. All right, and they can come in, and you can partner up to acquire the properties you need, right? So they bring the money, and maybe you bring the deals, the management, and the first position lending, right? So those are the primary and maybe easiest sources, and there's a bunch more. All right, so I'm going to go through this part pretty quick. There are about 6 different ways we can pay for property. We use 3 of them. So I'll go over them all real quick. This applies not just to rentals. This is for everything, guys. So this is like some financial genius stuff. Let's say we have a mystical house for $100K. Option 1 is I can reach into my bank account, write a check for $100,000, and boom, I own a house. That is the easy one. Option 2, I can get that first position lender. I can get my bank, I can get my Mark, I can get my Cheryl, and they're going to go ahead and pay that first $75,000 for me. Isn't that nice? So I only have to reach into my pocket for $25K. That's easier. I like that. Option 3, I can get me a private lender. You guys have heard about this for all your rehabbing needs, right? We can find somebody somewhere who will just give us $100K. There's going to be terms associated with that, but they'll give us $100,000 and we got a house. Great. That's fun. Option 4, this one gets a little more interesting. I can get Cheryl or Mark to give me the first $75,000, and I can get my private lender to give me the other $25,000. Now I have no money in my pocket, and I don't need somebody with $100,000. I can use somebody with less money. Or maybe if I got that private lender that has $100,000, maybe I buy 4 instead of 1. Option 5, this is the way we do it. So if you guys want to know how I buy 100, 200, we're going to go for 400 units in the next 12 months. This is how we do it. I will get a first position. I'll get my bank. I'll get my Cheryl. I'll get my Mark. So write me that first position note at 75% of my purchase price. I reach into my wallet, and as much as it pains me, I pay the $25,000 myself. We close, we acquire the property. The day after I close that thing, I start contacting my lenders and I say, hey, I just bought a rental property. It's cash flowing, it's got a tenant in it, nothing's wrong with it, we're super happy with it. Would you like to get yourself a nice 30-year mortgage going on and get some returns growing in your retirement account? They tell me yes, they write me a check for $25,000, and I now have $0 in the deal, and if I did it right, I now have an infinite return. I take my $25,000 that they just gave me back, and I go do it again. That's how we buy so many. These are the ones you want to use, guys. The reason we don't use number 3, reason I will not use 100% private money, is because private money is a very limited commodity. We need it. We need as much of it as we can get our hands on. I don't care if you got 20 grand or $2 million or $10 million, doesn't matter. You need every penny of that stuff we can get our hands on. I want to leverage and make it go as far as I possibly can. So I don't want to blow the full 100 grand on one property. I want them to have as little in that deal as possible as well. Okay. All right. So what does a good property look like? First thing, at least with turnkey, we care about no major repairs in the first 5 years. When we're buying these, we rarely have a high enough reserve to be able to cover a catastrophic thing. So I can't have the roof collapsing on me 30 days after I bought it. That's not going to happen. So we need to make sure that we specifically care about the major stuff: roofs, foundations, mechanicals. They all got to be solid. No major problems there for at least 5 years. That's going to be part of your due diligence. That doesn't mean the property has to be rehabbed, but if you're rehabbing the property, especially if you're going to keep it yourself, maybe you got a furnace that's a little bit shady. You're like, it would go. Maybe you would sell that retail, but you're not going to do it in a buy and hold. You're going to replace it first because you do not want the problem. Okay. With rental property, our problems stay in house. So do not screw yourself over. Make sure that that property is good for 5 years. Metrics wise, cash on cash return. For a middle class property, our BC stuff, I want 10%. That's where I'm at. I think I think in the rental boot camp, I haven't been to it in a while, but I think they teach 9.5 for turnkey. So 9.5, 10%. That's okay. That works. Most of the time, that's going to give you the kind of cash flow that we need to be functional. If you're going Section 8, though, if we're going to go to a CD level property, that's all good. I'm probably going to want to see closer to 12 or higher for that. Remember, our risk reward is different. I want the higher rewards, all right? Cash on cash return is based on your financing, so it's a little harder to calculate. The property must appraise. I am aware of several of my competitors, several turnkey guys out there who will have their buyers sign a document that says that if the property doesn't appraise, you will bring the difference to closing. Pardon my French, that is epic bullshit. Don't do that. If the property doesn't appraise, your lender isn't going to lend you more on it. You are not going to pay more than the property is worth. That's just crazy talk. We don't do that. So it has to appraise. If it doesn't appraise, it's a problem for your turnkey provider or it's a problem for the seller. It is not a problem for you. We have no issues with that. So we're going to pay the appraised value and not more. We want that property rented or already rentable within 30 days. This is pretty important. Some turnkey providers, I don't do this, but some of them will actually have, they basically do a BRRRR for you. So they'll get you a property that needs a significant renovation. They'll send a team in, and that team will do that renovation within a few weeks. What's going to happen then, once they got this shiny rehabbed property, you've already paid for it. You paid for it back and funded the renovation. Then it's going to be turned over to management, who's going to put in a tenant. The thing is, most management companies have what they call a placement fee. And that's when they sign up a shiny new tenant for you, they get the first month's rent. So if I buy a property today that needs a renovation, let's say that renovation, let's say they tell me it was going to take 4 weeks. So we got a 30-day renovation. If it goes on even a week longer, doesn't seem like too big of a deal, but now I'm into 2 months of holding costs. And then management signs up a tenant. You got to give management a minute. No matter what your market's like, it's going to take them at least a week or so to find a tenant and sign them up, right? Most of the time, probably 2 weeks. So we're going to be potentially 3 months in before we can start seeing cash flow. So if you didn't account for that up front, that can screw with your numbers a little bit. So I like to see rented or rentable within 30 days. In our business, I will actually pass on a property that we can't place a tenant in within a month, right? We don't like it. We don't even bother with it. We look at the portfolio in its entirety rather than the income of an individual unit. Units have to make that minimum, but I really am looking at an average. So in my business, we don't deal with single properties. We deal with 5 or more is the bare minimum we will touch. I'll give you kind of an example. We had a portfolio a month or two ago. it's a BC class, and these things were crazy good. 4 of those properties had, I think, it's a 13-14% cash on cash return. Very, very high, making over $300 a month after every expense you could possibly imagine. They were amazing. And then one of them, just one property, came in at 10%. Our initial buyer refused to buy the portfolio because they didn't like the one. So that's really short-sighted. It took me all of about 10 minutes to sell that to somebody else. So when we're looking at them, we're buying in bulk. It's in my business. That's how we get the pricing that we get. It's how we take advantage of getting you guys fantastic returns. A seller is not going to say, let me cherry pick their best properties and leave them with crappy ones. That's not how it works. So we adjust it and we look at the entire portfolio. If that portfolio averages out to, let's say, 10, 12%, whatever, depending on the class I'm in, then I am perfectly happy as long as they check all these other boxes and the properties appraise. So we're not going to throw out the baby with the bathwater. So, all right. I think that's all I have for ranting and raving tonight.